Hi, everybody. Good morning, everybody. I'm seeing that you guys are all popping in here. I would like to know where are you guys popping in from? Where are you guys joining us today from? Hi, Mark. Where are you from? Austin, Texas. Nice. Mark, where are you from? MKE. I don't know what MKE stands for. Oh, Milwaukee. Okay. That's a Minnesota way of understanding what that is, right? Well, welcome. I bet you it's cold there. Alabama, nice. Charlotte from Germany. Awesome. Well, welcome everybody. I'm super happy to have you all here. What do you guys trade? I would love to know not only what do you trade, like do you have a specific strategy, a different way that you enjoy trading? I would love to know here. Put it in the chat box so that we could all kind of see what you guys are up to, like what you trading, the kind of stuff that you trade, options, okay? What other stuff? CFDs, okay. Futures, the NQ, good. The ES and the CL, good. All right, awesome. All right, well, today what I want to talk about is more, I want to focus on a a strategy that I personally use, and that's about scalping. I don't know if any of you guys have ever heard about scalping. I personally love it because the majority of my trades today with a high volatility, especially after COVID began, I know that there was this massive drop, but then once COVID began, the volatility, I guess, because everybody was kind of sitting at home, was amazing, right? I mean, I've always been a scalper for like almost 9 years. I've been scalping, but there was a point where I was scalping. The majority of my trades were between 3 to 15 minutes. Today, there are times when I'm in and out of trades within 30 seconds to less than a minute. It's absolutely incredible, right? So I want to talk a little bit about that today. So let's hop in. But before we do, I just want to say really strongly is that the whole point of these presentations is that you guys come out really learning something. And even if it's just that one thing that you could really take and implement into your own trading style and just trading, right? And I'm sure the reason why you guys are also here is because you're probably having some challenges, you're probably having some questions, and I'm here to respond to help you with that. So please ask questions, please be interactive. I always say that day trading, it is not a spectator sport, right? The more you get in, the better. And in this particular case, it's asking questions, it's curiosity, right? And that's what it's all about. So let's begin. Why scalping the futures E-mini? I personally trade the E-mini is less stressful and much more profitable. What I have noticed in the past couple of years that a lot of people are able to use these scalping ideas for any instruments that they trade, right? Because it's all about understanding how to scalp. So before we jump in, this is me. Hi, I am Marina, the trader chick, and I have a confession to make. I am a scalper. This is for real. I love scalping. So the interesting is the fact is that how I stumbled on to scalping, because interestingly enough, I didn't even know scalping was such a thing until I started to talk about the strategy that I use. And of course, how did I learn that lesson and how did I evolve as a scalper? Because it all happens from a huge loss, right? I'm noticing that the majority of the mistakes, a majority of the huge lessons and I guess benefits in life and lessons that really elevate us to the next level happens from huge mistakes. In my case, it was a huge loss. I literally lost almost $4,000 within a 5 minute span. And at this point, it was not my first massive loss in the past several months, and but this one was the most devastating of them all. Why? Because at this point I have been trying to trade for over 2 years. I was chasing a trade and I would not permit myself to admit that once I was in that trade that it was going the wrong way. It all became this catastrophic downward spiral of emotional trading, right? And unfortunately, I blew my account literally in 5 minutes. This was the third time in 2 months. And as I mentioned before, it was an emotional downfall, emotional domino effect, because after that, I did not stop. I actually ended up revenge trading for another 2 days. That in reality, I almost ended up losing $6,000 altogether. It was horrific. And that's when I literally and completely had a total breakdown. I remember it was April, and this was like it was the final straw to me really struggling. And it was such a big hit that I literally was laying on the floor in my bedroom. That's where my office was. And my husband comes in, standing over me, and he's like, "What in the world are you doing?" And at this point, it wasn't even about the financial loss. It was just all those years of struggling, all that time, all that money lost. And I just felt like a complete loser, right? And what happens when you have total breakdowns? You come up with two decisions, right? We all have been here. When you guys have a breakdown, you normally have two decisions to make. One, you either quit, you get out, whatever it is. In this particular case, it was me trading, or you have a breakthrough. So I don't know if any of you guys have ever watched the movie Nacho Libre. If you haven't, I really recommend it. It's such a good movie. It's so funny. It's super family friendly. Anyways, there's this one part of the movie where Nacho, he is the main character. He's desperate to be a luchador, which is a wrestler, a Mexican. In Mexico, they have this lucha libre Mexican wrestler. And he's terrible, terrible at it. And he goes to church and he's praying to God. He's like, "Why did you give me this incredible passion to be a warrior and made me so lousy at it?" And I literally felt like that. I'm like, "Why did you give me this incredible passion, this want to be a day trader?" And I just feel that I'm so bad at it, right? And then at the end, obviously, he goes on to win the biggest, wrestling match, blah, blah, blah. But I felt like that. And basically, for me, I had a total breakthrough. So, what I did though, I did completely quit. I totally walked away for about 3 or 4 months. But as we all know, for day trading, it's hard to stay away because deep, deep down inside, we know that we could do this, right? And it's like, I call it the trading bug. It never stops itching. And when I came back, and what I decided to do was take a totally different perspective and approach. I had 3 monitors going on. I literally took 2 of my monitors and threw them in the garbage, literally, physically in the garbage. I had over 10 indicators going on. I removed them all and just went in looking at the bare naked charts, right? Started to focus only on the basics, because one thing I did realize is every time I asked a basic question, I was always either completely ignored or treated like I was born with this information. And I recognized that nobody actually taught the basics. And that's when I went back and just started to listen and read the charts. And I noticed that it was a language, and I literally became fluent in the language of understanding what the charts and the market was telling me. And that's kind of how I fell into the scalping world without even realizing it, because slowly I put in 2 indicators. When you have indicators, what I realize a lot of people do, they put in indicators for the sake of having indicators, because they hear all these different people talking about this indicator, that indicator, but nobody actually goes and once they put it on their charts, saying to themselves, "Is this indicator really working for me? Is this really working for me?" And a lot of people, they don't ask that question. They just assume that it has to without actually putting in the work of seeing if it does. And instead, it just gives a massive analysis paralysis. And the other thing is, another thing what I was being taught is to go for really big targets. And they weren't working for me, because when I was going in for big targets, I had to put in big risks. And it was just, and I couldn't sit through waiting for these big targets. So I started to realize that if I go for smaller targets much faster, not only was I hitting the profit target, but I was gaining confidence in myself, right? And the majority of my trades back then, this was like 8 years ago that I started to recognize this, was between 3 to 15 minutes. Today, though, like I said, it's between 30 seconds to 3 minutes, because the volatility is much higher today. And when and that's when I started to realize that it was much easier for me to handle it. And also I didn't have to deal with a lot of the stress. And I was actually having fun with my trades. And that's when I started to talk about it. And people are like, "Well, you're a scalper." And I had no idea about that. And that's when I realized scalping is really a great way, and probably for a lot of people. So I want to go in first before we jump into the actual presentation, do a quick intro. Like I said, I am Marina, the Trader Chick. I am an expat living in Antigua, Guatemala. And before I became a day trader, I was actually a fitness instructor and a travel writer because travel for us is it's a necessity. It's not a luxury. And everything that I do has to revolve around traveling, and day trading obviously fit into that beautifully. And as I mentioned before, I recognized that the market had its own language and I started to become fluent in it. And I think that's because I am trilingual. I was originally born in the Soviet Union, so Russian is my main language. I was a refugee and we moved to the United States when I was really young, so English came to me like second, like second nature. I didn't actually learn it. When you're a kid, just happens. But I did learn Spanish in my late 20s, and that was a whole process. And I recognize that the process is very similar when I started to read and learn the market language. And I applied that process that I used to become fluent in Spanish to understanding the market language. And the best part about trading, you can literally do it from anywhere in the world. It's so awesome. And like I said to you, I literally threw out my monitors and now I am one chart. I'm able to take it anywhere. I have two indicators, and that is it. And I've also been featured on quite a lot of summits, presentations, and I used to do a lot of live shows, Money Show, Traders Expo before COVID, obviously. Now I really enjoy my virtualness. So before we jump into like the actual scalping part of it, you have to have a foundation, right? So that foundation comes from the basics of day trading. And that's what I really want to talk to you guys about today. Before I go into the full presentation, I have all of the presentation that you could use along with this presentation. And I know that Anna's going to be sending over replays. You could use this worksheet that I'm giving you completely for free. You could go here right now to download it at makingofadaytrader.com. 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 Ready, guys? Download this worksheet that you can follow along with the presentation, and let's hop in. So this is my chart. This is it. You guys need to have a charting software. You cannot be a Formula One driver driving a minivan. You need to have the proper vehicle. For us, for day trading specifically, you need to have a proper vehicle, and that is charting softwares, right? That is platform. You need to have the right one. So this is my charting software. I use two indicators. I use EMA lines and MACDs, nothing else. This is it, right? I removed all my other charts, on my other monitors, all the other indicators, because at the end of the day, this is what I recognize that works the best for me. Now, let's begin with understanding market movement. If you guys don't understand the basics of the trend, you're never going to be able to take advantage of the different trends that are going on and the different setups. So we all know that there are technically, logistically, three trends. One is the upward trend, the other one is the downward trend, but the most important one that you need to understand, avoid, and learn to see when it's happening is the sideways trend, because I call that the trader's worst enemy, right? This is that indecision area, the exhaustion pattern, you name it, this is what it is. Okay, trending markets, what are they? So you have the downward trend, sideways trend, upward trend. Just a quick background on them, just a quick understanding. What is an upward trend? It's when each pivot is higher than the next. Literally, it's each pivot is going higher than the next. You call this the bull market, market trending up, whatever you want to call it. It's going long. It's when you are buying, when you are entering the market at a lower price point, exiting at a higher price point, and taking that profit in between. What is a downward trend? It's literally the opposite. It is when each pivot is lower than the other. It is when each pivot is lower than the other. Okay, it is a market trending down, market going down. You are shorting the market. You are selling. What does that mean? It means you are entering the market at a higher price point, exiting at a lower price point, and you're taking in between. That is a downward trend. And if you're sitting here saying, well, I never short, well, then you're not really a day trader, right? Because day traders, we make as much money, if not more, when you're shorting the market. All right, this is what it looks like. Now, let's really, really talk about consolidation and transition areas because, like I said, they are the traders' worst enemy, and you need to learn to spot them and understand them. This is what a consolidating market looks like. This is that in between, that indecision area is when it's bouncing back and forth. Do you guys see that there is no real movement here? There's no flow. You do not want to be throwing your money at the market guessing in which direction it's going to go in. And that's what happens when we're seeing these transitional areas, right? Because a lot of people, they're like, okay, the market's been heading in this direction. It's got to continue even when it's a transition area. And they start to put in trades and they keep on getting stopped out because this is a place where the most important thing to do is to stay out entirely. Because as individual retail traders, our jobs are to do three things. One is to know when to get in. Two, know when to get out. And three, know when to stay out. And when we are seeing a consolidation, a sideways market, an indecision area, the chop, exhaustion pattern, I don't care what you call it, you need to stay out. This is what it looks like. All right, these consolidations happen all the time. Since I'm a scalper, this mini consolidation can totally stop me out, right? Because I'm going for shorter, smaller profit targets, right? You can't get the profit. No, you're not getting a sales pitch. It is literally a free presentation that is given to you. So you're probably not in. You have to put in your name and number. Name and email. It is totally free, no sales pitch. Okay? makingofadaytrader.com. Dennis, I will go in to the live market and I promise I will give that to you. So you will see in a bit what my three EMAs are. All right, now, how do you spot a consolidation area? How do you spot a consolidation area? Because they're areas. What are areas? They are your support and resistance areas. And if you guys are sitting here right now and saying, I don't know what a support resistance area is, and you are in the live market, I'm sorry, you guys, you are going to be losing and you're going to be losing big time. Why? So we all know Formula One racing, right? You don't have to be a fan. We just know what it is, right? It's also a very known fact, especially amongst the drivers, that 25% of the drivers during the racing season are either going to have an accident or fatality, right? So what do they do before they hop into their car? They are going to be fully ready. What does that mean? They are going to put on their seatbelts. They are going to put on their helmets. They're going to have their fireproof uniforms on, right? Because they understand the risk. Day trading, there's 95% chance that you are going to lose, yet nobody's putting on their safety gear. What is the safety gear? I like to call it support and resistance areas safety gears because this is where it's telling you where it's bouncing back and forth. Support area, bouncing back and resistance area. What is a resistance area? What is a resistance area? And this is not something you should be mentally putting in. You need to be drawing this in because mentally putting in a support resistance area is like mentally putting on a seatbelt. It never works, right? So what is a resistance area? It is a place where you are hitting the ceiling of the market 3 or 4 more times. It is an area that the market is respecting and you need to respect it with it. You have to have these areas drawn in because it does not matter how strong the movement looks. If it's a strong resistance area, it's going to go hit off of it and stop you out. All right. Resistance area, the ceiling of the market. What is a support area? It is the floor of the market, the floor of the market. All right, what does that mean? That means the market is hitting an area at the bottom over and over again, and it is respecting it. You, as the trader, need to know that, respect it, draw it in, and stay out until the market tells you what it's going to do next, either a breakout or a transition. Okay, this is what a support area looks like. So you need to be wearing your seatbelts at all time. Get those safety gears on because when you're in this ugly, ugly channel, do you really want to risk the hard-earned money that you've been working for and putting it in here when there's absolutely no direction? You will never beat the market. You will never ever predict what the market is telling you. So stop pretending and work with the market rather than against it. And what does that mean, working with it? It means the market will tell you when it's going to break out, when it's going to transition. Okay, so how do we spot these areas before they get into the full area? That is with reversal patterns and divergences. And I call this the trader's map to shift in direction and trends. So what exactly are reversal areas? They are the double tops, the triple tops, head and shoulders, double bottoms, triple bottoms. Okay, so when you're spotting these, and this is for free, guys, on any instrument, as long as you have a good, strong platform, you have to understand how to read the price action. What are these reversal patterns? They are not 100% indicative that it's going to reverse. What they are telling you is that the market is coming to a standstill, an indecision area. It has a very high potential of reversing, but we don't want to predict that it's going to reverse. What we want to do is stand back and see what the market is doing. It is telling you, sit back, let me do the work, and I will confirm when it's time. What is a divergence? I love divergences. I live for divergences or reversal patterns because they are screaming to me to sit out and wait until the market is ready. What is divergence? So here we are, price action. It is moving up. My MACDs, on the other hand, are telling me, no, it is slowing down. Do I want to be in a market where the market is in a slowdown? Absolutely not. I always want to be on the right side of the market. So I'm told, sit out, wait. It will tell you when it's time to move on. Here is a perfect example of a double bottom, massive divergence, and a boom, a shift in that direction. Now, I want to put this all together for you guys so that you really grasp and understand how it works. Now, again, the entire free worksheet, it is a free worksheet. I know because I get a lot of people telling me they love my PDF on this. Get it right here for free, makingofadaytrader.com. You do need to put in your email, but it is not a sales pitch. Okay, so easy when you see the whole chart. It is dark, but however, if you're seeing that there is a reversal pattern, you don't need to see the full chart. You just need to see what is happening in front of you. Okay, so I'm in your right. How many days will this room be open during Christmas? It's open through the, yeah, I don't close for holidays. Christmas is on a Saturday anyways, right? So it's all good. When the market's open, so am I. All right, continuing on, guys. We want to put all of this together. How can we utilize this? How do we understand how to use this? Because here's the reality, guys. Here is a perfect double top. It's already telling us that something is happening. And then I start to draw in my resistance area because I've got this whole area being drawn in right here, correct? Now, if I don't have it drawn in, if I have a mental stop, or if I don't even know what a resistance area is, I'm going to miss out on the best kind of setup that there is, and that is called the breakout, right? We've all heard of breakout trades, right? We all know that the breakouts are pretty much the top trade setups. Why? Because when you have that extra breakout, you've got that energy in the markets. But if you don't have that area drawn in beforehand, you can miss it. So let me explain to you what a breakout is in layman terms. So imagine you are living here. Imagine this is a map, right? And you are super south right here. And your best friend lives super north of you. And your best friend calls you up and they're like, hey, come on over. I have this awesome party coming up. I just did it right now. Let's come on over. You're like, okay, cool. So you hop in your car. You've been there a million times. You hop in, you hop on the highway, totally full of confidence, and you're driving. But all of a sudden, there's this massive construction site and a detour, and the construction worker is like, you got to get off. The road is closed. I don't know about you guys, but I totally freak out during detours. I get really stressed. Why? Because one, what if the detour signs stop and I don't know where I'm at? Sometimes Google and Maps and Waze isn't caught up yet to, the detour. What if I run, what if they never reopen the road? What if, what if, what if? So what happens when I'm in a what if situation? I'm in an uncertainty, right? I don't know. I'm doubting. I'm not sure. Do I want to be betting on the situation when I'm not sure what's happening? That's that consolidation area, correct? That's that area when we're uncertain. So why are people putting in money? Because I can guarantee you right now, I can bet the farm on it that the majority of the money that you guys are losing when you're trading is usually in those consolidation areas, right? So you have to have these drawn out. Now, and you're driving through completely stressed out, and all of a sudden there's this huge sign, and the construction guy is like, yeah, cool, it's open, the highway's back open, hop on right here. That is the breakout trade. You get back on that road, you are full of confidence, and you are headed back to your friend's house. So are you going to be putting money on that one? Absolutely, I will, because I'm confident again. There's a burst of energy, a burst of confidence. That's the breakout trade. All right, so you're driving highway, all of a sudden, consolidation area. I'm not sure what's going on. Oh my God, is it going to close? Are they going to reopen? Not sure. I don't want to be putting a penny into this part. I am not a gambler. I am not a risk taker. I am not an aggressive trader at all. On the contrary, I think people who are aggressive, that's when they lose all their money. I'm crazy conservative. I wait until the market talks to me, and boom, it totally does. Right here, it gives me massive, massive confirmation. So how does my breakout trades look to me? As I mentioned earlier, I only use two indicators. I use the EMA line and the MACDs. I have found that the MACDs are the least lagging indicators. And here I am in a massive consolidation area, massive resistance area, total weakness. I'm close to the zero line, and boom, I have this beautiful breakout. Look at all this movement up. Absolutely no divergence. So I am sitting, waiting for the breakout trade to come to me. I never, ever, ever enter market entry. If you guys are entering market entry, that means you are amateur traders. You never want to have zero control over where you're entering, because if you're entering at a market, that means you don't know what's going on and you're guessing. Oh, I think this looks good, I'm going to enter. No, you have to have an order waiting and a limit order for you. That means you are telling the market where you are entering, where you want the price to enter you at. And boom, this is where it's at. You pop up, no divergence, a massive move. I'm telling the market I want to enter right here, and that's how I do it. Now, another bonus trade setup right here. And because I only go in for really quick trades, scalping, I can get in and out really quick by reading what the market is telling me. So here is another massive resistance area, and boom, I entered a transition trade where the market has gone through massive, massive movement down. That's where I'm doing it. Now, I am going to go into the live market for you guys right here, and we are going to be examining the live market. Look what is going on right here. Okay, so this was yesterday's movement, and I always make sure that I draw in my areas. Why? Because remember, like I said, the market respects areas, and you, as the trader, a retail individual trader, you have to also respect those areas. And because I am a scalper, I do not look at big time frames. I don't care for the big time frames. I'm looking to enter really quick, small time frames. Look at this area right here. Massive resistance area. Guess what I'm going to be looking at right here, guys? I am going to be going all in on this breakout when it comes back to my EMA line. All right, Dennis, you wanted to see my indicators. Here is my indicator right here. Oh, what's going on here? There we go. Okay, so here are, I use 3 EMA periods. I use the 52, which is my red solid line. I use the 20, which is my purple dotted line. And I use the 135, which is a larger time frame, the orange line right there. So also, I don't know if you guys have recognized, but I use a tick chart. I do not use a time frame. What does that mean? It means, what is tick charts? Tick charts are transactions per bar. I look at the 610 tick chart. That means there are 610 in at the moment, real time, live transactions happening right here, right now in front of me. And as you can see right here, I use the tick remaining to see how quickly, what is the volatility of this particular time right here. So it is actually going quite slow. What it's showing me is that there's not that much volatility. And why does it matter for volatility? Because when there's volatility, there's more certainty, there's more flow, there's more movement, right? I do not use a volume indicator because volume indicators are notoriously known to be the most lagging. They're lagging, right? They are not in the moment. So I really love to know what is happening right here in the moment, right in front of me. That is why I personally love to use the tick remaining, the tick counter. Okay, Marina, did you draw those lines in the MACDs? Yes, I draw them in. They are my own personal indicators simply because over time, what I recognize when I am above right here, when I am above zero point 0.3 and zero point 0.4, that is when I know that there is the most amount of strength in the market, especially when it's going high with zero divergence and I enter around here. That's when I enter. I never enter the market when they're below because that's what showing me a lot of weaknesses close to I love to do. This is how I like to watch the market. However, I'm also noticing something right here. It's an area, right? This is an area. So at this point, I'm really going to be cognizant, very weary of this area because areas are an average. It is not really, really specific. It's an average because I only go in for about a point. So my area is usually around a point. But look at this. This is pretty strong, right? And it's been a strong move out. If it hit me already, I would have entered, but now it's really hitting that area. So I'm not going to be entering the market at this because I know that this is my seatbelt and I want to be protected, right? Like I mentioned earlier, I am a very conservative trader because there are thousands of trades. Why do I want to risk something when I could get another kind of a trade that will give me a higher guarantee, a higher probability of filling my target, right? Okay, so this is the live market for you. This is how I talk about the live market. This is how you analyze it. As you can see, you do not need to spend thousands of algorithms, softwares, and all this other stuff because the reality is it's all right there for you guys. It's all right there. And it is simple to understand. And the beauty of it is that you can use it with any instrument. The thing is, guys, you have everything you need to take action, absolutely everything you need to take action. But the reality is, how do you know you're doing it right? How do you know? Look, self educating is awesome. There are YouTube channels out there, there are books, there are all these amazing summits. But at the end of the day, how do you know you're doing it right? Who is letting you know that, yes, this is a resistance area? Yes, this is why you need to understand why reversal patterns are so powerful. This is why you're going to understand when the breakout happens for that transition to happen. How do you know you're doing it right? Right? All of this is great, but the other real question is, how do I get started? I get this asked all the time, and not only from beginners, but from seasoned traders who have been trading for ages and are still not consistent. Right? They are constantly asking me, what can I do to turn this around, to be profit consistently? Because it's not about the one off. It's not about that one aggressive trade that you got lucky on, because those aggressive trades are going to lose you way more than you're ever going to make. It's about that consistency. It's about coming in and taking those trades day in and day out and winning consistently 80 to 90%. It usually starts and stems from lacking understanding of the basics. It's literally like driving a car. Okay. Have you ever been in a car with somebody who's just starting to learn how to drive a car? It's a beautiful thing to watch. Why? Because everything that you think that you no, for instance, for us, it's second nature. It's totally natural to understand where the gear shift is, where the brake is, where the accelerator is, where the windshield wipers are, where the lights on. But people who have never driven, or even better, have never been in a car, it's all new to them. They have to learn all this. That is the basics of driving a car. If you don't understand that, you'll never drive. You'll never get past the driveway. And if you do, you'll probably crash, right? And imagine you're being told, all right, you got to get your seatbelt on because this is going to save your life. But you've never been in a car and you don't know what a seatbelt is. How are you going to know what that is? right? How are you even going to know this is the mechanism that's actually going to save you and keep you out of trades? This is what that basic is, right? My own personal sad truth is that I spent over $20,000 on my trainings, $20,000, and I still struggled because it was too much. Nobody focused on the basics. Nobody told me where to begin. They just threw me in. The way I like to say it, if you want to learn how to play a musical instrument and you arrive to the academy, and instead of being taken music theory 101, you're literally thrown into the orchestral pit to play with pros. You're not going to be able to keep up, right? And that's similar to what happened to me. Exactly that. I was never taught the basics, and I ended up losing and losing until I lost that almost $4,000 in that 5 minutes. And like I said before, I quit. I walked away entirely. But I also told you that I was bit by that trading bug. And I know for a fact the majority of the people that are sitting here right now, you guys are all bit by that trading bug. And the reality is, it never ever stops itching. And why is that? Because we know deep down inside that we can do this. We could totally do this. And that's when I decided to get back to the basics. I don't know if you guys have ever heard of Coach John Wooden. He is a legend, was a legendary basketball coach, legendary, right? And it was his approach. I mean, this guy was amazing, and his entire way of training, of teaching was when in doubt, get back to the basics. I mean, this guy has won 88 national championships, 11 NCAAs. I mean, he worked and trained the superstars of basketball, superstars, right? But yet, every time they started a new season, he would start with the basics. He would teach them how to tie their shoelace, how to roll up their socks, how to dribble the ball. Why is that important? Because if you are on the court playing and your shoe is untied and you twist your ankle, guess what? It doesn't matter how much you know. You're going to be sitting out for the entire game, probably even the season. Is that what you want? No. So for you guys only for the people that are here today, because I really appreciate your live participation, I have my introductory course, Bootcamp for Day Trading. And you can do it on any apparatus, desktop, laptop, tablets, phones, it doesn't matter. This is the next step. It's either your first step or your next step. This is the step. Here's what you get in the course. First of all, understanding and simplifying that day trading process, right? A lot of people overthink things. And other thing that I realized so often, and I had my own issues, is setting up the platform can be really, really complicated at times. I eliminate that for you. It does not matter which platform you are on. I have the tutorial that you will be up and running in 30 minutes. This way you do not have to waste time and you can get moving immediately and learning the actual bones of day trading, the understanding of those trends, staying away from those sideways trends, understanding reversal patterns, divergences, really reading what the market is telling you, putting in the support resistance areas, understanding divergences. This is what's going to absolutely, I guarantee, up level your trading game. I guarantee it. And understanding the breakout mastery, the power of that breakout, the fake out breakouts, staying out of them because they could be deadly. They could take your money. And there's a way to avoid all of it. And excuse me, on top of that, you get unlimited access to the curriculum. All this is valued at $1,600. Bootcamp for day trading. Bootcamp for day trading. You get all of this for $1,600. But as I said before, how do you know you're doing it right? How do you know you're doing it right? Why is it okay for athletes to work with coaches and mentors and for everybody else to be just doing it on their own? So I've eliminated that. With this program, with my introductory program, I'm going to give you 1 month completely for free, unlimited mentorship. 1 month unlimited mentorship, unlimited feedback, one-on-one, not in a group setting, one-on-one. $500 that is usually worth. And on top of that, I also have a live trade chat room. You will get 30 free days in that live trade chat room. Totally free, included in this. All of this is worth $2,600, but for the live people only, participants only. One-time price, one time. This is not an ongoing, this is not a membership. $97. $97. Go here right now. Bootcampfordaytrading.com. 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 Okay, so bootcampfordaytrading.com, $97 one time. Guys, we all know that you are putting way more money on each trade. You get 1 month of working with me one-on-one, and on top of that, 1 month in my live trade chat room, plus the entire curriculum, seeing how we implement it in the live market, trading live. Bootcampfordaytrading.com, $97. This is a no-brainer, guys. No brainer. Okay, so let me hear. Marina, did you draw? Right. How many trades do you look for in a trade? Because I am a scalper, I only trade for about an hour, hour and a half per day, usually between 1 to 3 trades. And if you're thinking that's too little, that means you're not a pro trader. Ask any pro trader. Nobody goes for more than 1 to 3 because you know what? That's greed. And by then, you'll probably end up losing money as well. If you get really strong 1 to 3 trades, you are making really good money. What is my charting program? No, it's not Thinkorswim, but you could use Thinkorswim. A lot of my students are on Thinkorswim. It's fantastic. I use NinjaTrader, but you could totally use Thinkorswim. I love Thinkorswim. Um, Larry, how should I expect the live trade room? Can you please write to me personally, Larry, since you're already in my program? You have my email, and I'm happy to answer all of that, and you have access to all of that. Okay, how would you do this with an IRA? So an IRA is your retirement account. I do not recommend trading in your retirement account. Okay, definitely do not want you to trade your IRA account. Make sure that your trading account is not where your retirement money, all your other money is going to be in. Okay, it's really, really important. All right, guys, bootcampfordaytrading.com. And here are what some of my students have to say. And I have students from all over the world because trading is amazing like that. I just finished the boot camp, best money ever spent, unbelievable feedback. I mean, it's just it's invaluable. This course is absolutely amazing. Marina is an amazing teacher. This course is great. Zero experience, and I'm non-techie, non-math, stay-at-home mom, and I'm totally catching on. Guys, I normally charge $297 for this course. You're getting 66% off, one-time deal, $97, bootcampfordaytrading.com. The thing is, though, here's the thing. Because of my one-on-one mentorship, I'm only able to take on 25 students. Only able to take on 25 students, okay? So you got to get it right now. And here it is. When you go to bootcampfordaytrading.com, bootcampfordaytrading.com, you could actually get started with $59, literally $59. Okay, you know that this is way less than any trade that you're going to be taking. And with me, with a one-on-one, honestly, you cannot go wrong. Bootcampfordaytrading.com. Mark, how to get little more funds in my trading account? I can't do day trading yet. Why not? You could start with $100. It depends on the instrument you're working with. You could easily, that you do not need a lot of money, guys. That is a total misconception. Okay, you could easily get started. Definitely don't go for the margin accounts, but you could 100% get started. Just curious, I'm in the process of finishing OTA, and they are teaching trading in demand supply zones called Corex. That's the name of their strategy, but it sounds like it's a resistant and support area. I don't know. Everybody, it's kind of like everybody has their own way of calling things. So because I don't work with Online Trading Academy, I can't tell you if Corex is similar to what I'm doing. Sorry. Again, it's $97, guys. It's kind of a no-brainer. I know that, you're here, you want to do the freebies, but the amount of time that you lose trying to self-educate and trying to figure out what's right or wrong, it's unfortunate, to be honest with you, because our only commodity in life is our time. You get 1 month with me, and that alone is completely priceless, right? So I'm here to answer all of your questions one-on-one for $97. So I'm really hoping to see you guys in boot camp for day trading. And I'm really, really grateful that you guys spent this time with me right now because I know how valuable each and every moment of our time is. So I hope to see you guys in boot camp for day trading. And thank you so much for being here. And Anna, thank you so much for having me once again. I really appreciate it. Bye, everybody. And if you have any questions, please always let me know. I'm here to answer all of your questions. Yes, this is definitely recorded.
Good morning, everybody. Thrilled to be back with you here. It's always a pleasure to share with you lessons that I've learned across more than 30 years of stock and options trading. And today I'm going to focus you on how you can learn my weekly options accelerator strategy. It's something where weekly options are a really powerful tool to get leverage on big name stocks that you can get a piece of for typically 2 or 3 days maximum, is as long as we're going to hold these. We're not trying to day trade with this strategy. We're trying to kind of be more of like a faster swing trade over 2 or 3 sessions. So that works real nicely even for smaller accounts that you don't get hung up on day trading rules. But as I get into it here, I just want to remind you that everything that I share with you today is for your information and education only. It's based on our proprietary research. It's tended to be illustrative purposes and only, and not construed as specific advisory recommendations. Stock and options trading have large potential rewards, but also have large potential risk. The past performance of any trading system or methodology is not necessarily indicative of future results. And see our terms of use on the bigtrends.com homepage for more information on this. So if you don't know me, I've been trading for more than 32 years. I got started trading in 1990 now on a full 32-year window here this month. Interestingly, I've made kind of the classic early mistakes. So it's one of those things when you get started trading, they say sometimes it's better to make the mistakes and learn from them than actually to get paid off right away and think you're a genius and then go get set up for a bigger fall later, right? So the important thing out of all of that is to realize whether you're winning or losing early on in your trading experience that you need to have a plan, a formula to execute your trades consistently, knowing that there's going to be winners and losers, and that knowing that your job is to follow whatever system you think best fits you. To me, that's where my approach when I launched Big Trends back in 1999 was saying, you know what, I really want to make sure that everything I do is based on a trading systems approach, not on just a seat of the pants gut level, just throwing stuff against the wall and hoping something sticks. I think you're not going to be pleased if that's your strategy, to think that you've got, or more importantly, if you think you've got a fundamentally sound view on a stock, but you're trading short-term options on it. It's a totally different type of a game plan for options trading compared to, say, long-term stock investing. So what I want to share with you today are 3 of my key weekly option secrets, which are which stocks that work the best on weeklies with this strategy. I'm going to share with you the 80-20 rule applied to trading. And I'm going to give you my number one indicator that I think best defines a trending stock. And this indicator can be used not just across short-term swing trades like with weekly options, but also across position trades looking out a month or so, or even over longer term investing. Just change your time frame. Quick history on me. I started actually back right around the 87 crash, actually just after it. I entered a trading competition while I was at Duke University and was doing the classic value buying mentality. And after 3 months in a 4-month contest, was in the bottom quartile of participants, buying just solid Warren Buffett type of stocks like Coke and Gillette. I said, I better do something different. If it's not working, change the strategy, right? We all know that's a good idea, is if it's working, keep doing what's working. If it's not working, change the strategy. So I did some active trading in a month, took it from the bottom quartile to the top 1%, and realized that this is what I wanted to do, is trading for a living. And seeing that these short-term patterns can dramatically improve your results. So after graduating from Duke, became a stock and options analyst, at the time the biggest options newsletter in the country, developed a lot of new trading strategies, became their head of research in 95. And then in 99, I'd done well enough to start bigtrends.com November of 99. So we just had our 22nd year anniversary. And I played golf for a while and realized that I wasn't going to be Tiger Woods or the next great golfer, and realized that my passion was to get back into trading. So, essentially, that's always a good reminder when your passion equates with what you love to do and what you're best at. So, was blessed to be featured in the first year after I launched Big Trends in September 2000. I said, watch out below. This was a year before 9/11 that this article appeared as a feature interview in Barron's. And I said, this is a really dangerous market, because everybody at that time was coming off the tech bubble top at the end of the 90s, beginning of the 2000s. Everybody thought tech was the best place to be because it's been a great winning sector. And I said, this is dangerous. The market's dropping, tech is dropping, and yet people are buying calls and betting on the gift that they're being given in tech stocks like no other time I'd ever seen. And I said, the markets don't work that way. The markets don't give everybody a chance to hit it big, and nobody has to lose. It's like the markets are a constantly supply demand balancing game. If everybody's buying calls, you can bet that there's probably a short-term top in progress, because the buying power gets exhausted. And it's the same way when you see the market getting a flush on the downside, everybody gets bearish. We see the VIX spike, we see the put call ratio spike, we see all these things happening, and therefore all the put players get then burned after that. So the point was, I was saying that the sentiment was set up to have people be disappointed, and of course that led to a 2-year bear market. Fast forward a few years later to 2007, had the true honor of being inducted into the Traders Hall of Fame. And so it's my little crystal award there. But bottom line is that it's a nice, about a foot high actually, but it's a nice just reminder that I view a lot of what I've done as standing on the shoulders of giants. And what I encourage you to do is learn from fellow traders and myself here today about what makes sense for you and how you can implement that. Big Trends has been around for 22 years and counting because of traders like you. And so as a special thank you, I'm going to go deeper into my weekly options accelerator strategy than I usually would here for you today to give you some really nitty gritty details. And first set of details is which stocks. So the first secret, well, what do you trade? Part of the secret of trading, in my opinion, trading successfully is knowing not just what to focus on, but also what not to focus on. There's more than 500 stocks that have weekly options. And I've bulleted down in this strategy, weekly options accelerator, I call it, where we send out real-time email updates and text alerts to our subscriber smartphones when to get in and when to get out on every trade. In real time in the current markets. But the key is these are just the only 8 that we have to follow. Now, some of them are big names. Obviously, Mr. Softy, Microsoft would be the name that a lot of people would say should be included in the FANG list. It's obviously been a tremendous performer here, especially in recent years. Snapchat, SNAP, of course, is a newer name in the tech space, but kind of fits that social media push. Baidu, the Chinese Google, as it's called. Of course, China stocks have had a tough year this year. That, hey, we can trade the downside just like we can trade the upside. And then AMD has been one of our favorites, advanced micro devices in the chip sector. So half of the 4 of the 8, half of these are true tech names. And then you get into some other sectors like financial, processing, credit cards with PayPal, and some might say that's fintech, financial technology, but that's kind of a bridge, if you will. PayPal then into Canopy Growth, which is a cannabis leader. CGC is a symbol. Weight Watchers, a lifestyle brand. WW. It's about that time of year where we'll start seeing all those Weight Watchers commercials as everybody gets ready for their New Year's resolutions. Not a big fan of just making a resolution. You got to have a goal. You've got to have a plan. You've got to have a way to make that stick. And that's what I want to share with you from the trading side to get your 2022 kicked off right and keep it going into the future. And then Lowe's, kind of a competitor to Home Depot in the home improvement space. And Cindy says, if the stock goes down, do we change our target price? We are constantly evolving based on the trend, Cindy. So the goal for us is, okay, it's a function of if we have a trade on, we have a set profit target and we have a set stop, and then we know exactly how to manage that as we go forward. So you say, why those stocks? So it's kind of an eclectic list in some ways. The goal is, of course, with weekly options, we need speed. We need quick movement. We're also looking for stocks that can move multiple percentage points a day on average. So this is called the daily range, or the average true range is a more technical term for it. It's going to give you typically more than 1% a day. We're usually looking for stocks that'll move 3% or more on a day-to-day basis. So, but it's also based on the history of how well these stocks have performed over many past years of signals, up and down signals. We look at both. We do a lot of data analysis to say, okay, what's the history been on this? How well is it traded for us? Obviously, those are all pretty active enough names that we're going to be able to manage getting a lot of subscribers in and out of those very easily, so we don't have any dislocations as we send out our trades in real time. We're very confident about ability to get in, or if when needed, ability to get out. Now, if you're new to the concept of weekly options, The idea of weekly options is, when I was doing the strategy back in the 90s, I was doing it 1 week a month. Doing it the third Friday. Third Friday was a traditional, and it's a traditional monthly options expiration. This chart would be the 16th, the third Friday of the month. But now, of course, that changes. Now we don't just want to look at those options. We want to say every Friday. Now on this chart, there'll be 5 Fridays, usually 4 Fridays in a month, sometimes 5, and every Friday becomes an expiration Friday that you can take advantage of. The goal for us though is that we're not just going to trade options that are about to expire. Like for example, right now we have weekly options that expire tomorrow. If we got a signal today, we won't be trading those options that expire tomorrow. We'll usually be going out just over a week to the next Friday's expiration typically. Maybe on a Monday we might trade that Friday's expiration, because we're not going to hold these more than 3 trading days. But typically after Monday, we're already looking out to the next Friday. So we give ourselves a little bit of extra time, more than we need, because the big names all have weekly options going out many weeks, usually at least 4 weekly cycles looking out past the current Friday. So weekly options give you the way to not have to pay so much time premium, and that means you improve your leverage potential. The other thing is that with all those names I just mentioned, even including Microsoft, we're buying in the money options. We're buying options that have a lot of time, a lot of intrinsic value, and a relatively little amount of time value. And the time value is what kills a lot of option traders who end up holding too long and seeing their time get eroded. And yes, if you buy Apple stock, you can hold Apple for decades. And if you buy Apple weekly options, you might have it good till next Friday. After next Friday, those options might expire, for example. So the idea is, there's a complete different time frame and thus expectation about how you need to take action as needed. A big part of it for us too is that weekly options allow us the ability to kind of dodge the volatility you have to pay for with typical earnings reports. In the old days, if you're looking at an option that's say has a few weeks to go before expiration and the earnings are coming up in a couple weeks, then you have to kind of pay up for that if you're going to trade that situation. We would instead say, well, maybe we trade the weeklies the week before the earnings are going to hit, and that way we don't have to pay for that earnings related volatility, because the market knows when the earnings are going to be reported, right? So the idea is that, okay, we can kind of navigate some of those normal pitfalls a lot easier because of the flexibility that having so many weekly options choices gives us. Now let's show you an example on a success story here from this past month where this was AMD, Advanced Micro Devices, and we'll look at charts here too in a moment. But just to walk you through, we would call it out and say, hey, we're recommending to buy to open the AMD November week 2 118 calls. And I think we set up to about 8.5. We ended up getting them for $8.10 on average. Okay. And so what we do once we get that fill price is we send out a follow-up alert to all of our weekly options accelerator subscribers where we say, okay, we're in at 810. We're now targeting a double 1620 on the whole position. And we want it to happen within 3 trading days upon our entry. So all of our typical model portfolios are based on the concept that we assume that you could put in up to $1,000 into a trade, because we could buy an option that could be up to $10 for one contract, which multiplied times one contract controlling 100 shares, 10 times 100 is 1,000. So we say, okay, look, a lot of times we may just get one contract. Now, if you think about it, one contract doesn't sound that sexy, right? But one options contract controlling 100 shares, where 100 shares of stock would have cost you a little over, right around 11 grand. You say, we're controlling $11,000 of stock for $810. Now we're at a leverage ratio, as you can see here, of about 13 or 14 to 1. So the idea here is that that's plenty of leverage. And when we get our double, that $810 invested turns into $1,620. That's an $810 profit minus a couple bucks or less of commissions, because it's just a simple buy the contract on the way in and sell that same contract to close on the way out. There's no spreads, no adjusting of a bunch of different legs of a position. We're all about the KISS principle at Big Trends. We want to keep it simple. Keeping it simple is usually the most effective approach to long-term trading success. You don't confuse yourself. So one trader asked about pre-market rises and falls. We don't care about that. We're just trading typically on this strategy off of every half hour's closing bar. So we won't even get a new signal typically until 10 a.m. Wall Street time, Eastern time, on a given bar's close. It keeps it really simple, and a lot of the after hours or pre-market stuff is a lot of noise anyway. So we're looking for that prime liquidity in the prime market hours between typically 10 and just before the market close, about 3:45 is the latest we could send a signal, but usually it'd be closer to 3:30 if we got a final signal um, right before the close. Now, how do I find these trades? And let me talk about the charts to show you exactly what it looked like. So, and I'm going to walk you through these indicators to kind of share with you, what are we looking at? The good thing is that there's not a lot of indicators on this chart. It looks like it, but there's really not. On the top chart, we've got a moving average filter. I'll just call it MA for moving average. That black line is just kind of a safeguard to say, okay, if we're getting a bear signal, but we're above the moving average, we don't take that bear signal. What our experience is that you want to line up your short-term signals. Remember, these are 30-minute charts. These are from TradeStation's software, but you can use a lot of platforms. You don't have to be uh, fixed to any one platform. But the big thing that we're looking at here is on this bottom panel. This green cross point, this green line here is called the ADX, the average directional movement. We'll talk more about that as we go here. But this is essentially a trend indicator. You want to see ADX going up here. If ADX is going down, it means it's not in a clear trending phase. But if ADX is rising, especially coming up above, in this case, this is a positive directional movement in blue, net new highs in blue, net new lows in red are going down. So you're getting higher highs going up in blue, lower lows, or I should say higher lows because you're not getting any new lows relatively, right? You got maybe a brief one right here, but overall, looking back, it's been going up on the lows, up on the highs. What do we call that? That's called an uptrend, right? Now we see it in retrospect a little bit, but the point is that when we're getting enough consistency and it's just starting to cross up, to us, that's telling us, you know what? We want to be a part of this name right in here as it breaks out, and more importantly as it trends. If it was range bound, I don't believe there's a lot of predictability in trading ranges. You may have had some success at times, and our minds, by the way, are really good at reminding ourselves and selectively remembering what worked, but maybe not as good at remembering what didn't work. So you want to make sure that you're keeping a trading journal, you're tracking your trades and showing and marking down what were your reasons getting in or getting out, and go back and add all of those up. And I think you'll find that you may surprise yourself in the net effectiveness sometimes of what you thought was working. Make sure that it's working across both bull and bear examples and then across winning and losing trades added up. Point being that, if you're looking at this, it's okay. At that point, we get into the trade. This stock is trading here at about 125. We're buying a 118 call, 7 points in the money, and we're paying 810 for it. So what does that mean? It means that $7 of that 810 are intrinsic value, $1.10, $110 out of that 810 is time value, which means that if you held it to the expiration on the second Friday's close of November, if nothing happened to stay at 125, you'd lose the time portion of the trade, which is 110 out of your 810, less than 15% of your total position. What's great about ADX, you can see, is that we get some phases here where the price action starts to just sort of chop around, flag pattern develops, you go sideways there for a little bit. But look at how the ADX might slow down going up, but it's not rolling over. That's a really good sign to us. We actually even now use more of what we call a profit protection stop that we find even better than just waiting for ADX to roll over. So it'll help us to control our risk and protect a decent chunk of our profits as we start to make money. We start off with an initial stop that's more of a disaster stop just to make sure that we can control some kind of an adverse strong move against us. But the idea here is that, okay, these flat periods are where a lot of short-term traders lose interest because they go, well, I'm supposed to be making money really quickly, right? So therefore, I should bail if it's over a few hours, because remember, these are half-hour candles here. Over that second half of that first day in the trade, from about noontime until about 4, we were pretty much flat as a pancake, right? Just really sideways here. That didn't worry us. You see it starts to pop up the next morning, then has another brief little flat phase, and then pops on up to our target at the double. As the stocks rally from 125 up to the 133, 134 range. Obviously, around 134, it's worth 16 intrinsically, so we got out of 1620. And you see, in this case, it kept going to the upside. Why not wait until it rolls over? Because our experience is at that point that, the risk of reversal is increasing, especially coming into a next trading day. We don't want to take that risk. So our goal is to say, when we get our double, we exit first, ask questions later, put that double and that profit, one bird in hand, into your account, into your pocket, and be comfortable that you're taking your risk off the table and taking that profit down. We don't recommend just automatically taking a 20 or 30% gain. A lot of traders I know will say, oh, I got out way before you guys. And I'm saying, don't do that. If we can get onto a double, those are the ones that really carry the portfolio. Here's a Microsoft example where we didn't quite get our 100% profit. And this is where the full 3-day rule kicked in, where you can see here, got in the morning of October 14th. Notice we're not going to call the exact bottom on this strategy. That's not our objective. We're looking for that launch point, and it happened right off of the open at the 10 o'clock close. We're finishing in this bar right here around $300. So at $300, what do we buy? We bought a 292.5 call. Remember, if you're new to options, that's a right to buy the stock at $292.5. Well, at 300, that's worth $7.50 intrinsically, right? So you say, well, what do you have to pay for that option? It's going to be something above that, but not too much above it. $925 on one contract that controls the equivalent of $30,000 worth of stock, right? More than a 30-to-1 leverage, essentially, that you're buying when you buy this option. Now, at least at the starting point. So the goal here is to say, okay, we want to get that profit hopefully quickly. Now, this is interesting because in the old days, when ADX rolled over, the green line rolled over, I would have probably said get out. But actually, it went to about 304, and then it pulled back to just under 302, maybe even 301. You say, well, why wouldn't you get stopped out on about a 3-point move against you in the stock? Well, because the idea is that, okay, we start to protect our profits. So if we're up in the neighborhood of about, call it 30% for starters, we would essentially raise our stop to break even. And this is why the in-the-money options are so much easier to trade with a disciplined stop loss, trailing stop in this case, because you don't have that time erosion as a total hit as you do it on the at the money and out of the money options. Those options are all time risk. So even a little sideways phase can cause those options, especially on the short term weekly options, to erode a lot faster. This one, you can see if Microsoft is even just looking at the intrinsic value at 292.5 and say now it's at call it 301. Well, we know that, okay, that's still got to be worth the $8.50 intrinsically, right? So say it went up to, in this case, say it even went up to in the neighborhood of about, say 11, and then it pulls back to 8.5, 2.5 points off of the $11 peak. That's still only about a 20% retrace. That's not enough to flush us out. So we give it enough wiggle room, but not too much wiggle room to not let too much of the profit slip away. But the goal of any good trailing stop is to really control the drawdowns and to control that you don't get whipsawed by too tight of a stop, but you don't have too loose of one and give back too much. So the goal here is that you really want to just focus on riding the trend. We rode it up. Notice where we got out. We got out, the stock got to about 309. Then as it came back down to 308, our time stop is kicking in. The time stop says, look, you've been in this trade now for 3 full days. And you say, okay, it's time to say sayonara. It's time to say, don't hang around. We're out at a 70% gain. Now, 70%, what the stock did went from 300 to about 308. So 8 points on 300, not quite 3%. So the net leverage here, as you can see, ends up being somewhere in the neighborhood of about 25 to 1, which is fine. We've lost a little bit of time premium, obviously. But the beauty of this is that we're saying, look, hey, even just based on, that kind of a slow, steady march higher, it's a healthy return and not too much time in the market, 3 days of full trading for the time stop. So the time stop is a good reminder for all options traders that you have a window of time where you should give a trade an opportunity as an option trader. If you know what your typical window of time where a trade works is, when that time is passed and it hasn't worked as to the full target, maybe it's worked a little bit, we can sometimes get lulled in, especially with that stock trader mindset of saying, well, we're making money, we're right, the stock's going up, why don't I just give it a little more time? Well, speed of movement is what you need as an options trader. It's a little different than the stock trader mindset of just, I've got time on my side, just give it more time and it'll usually work out. Not the case with options trades, and very dangerous to come in with that mindset from stock trading and not realize you got to change some things up and be more stringent on your criteria and your requirements to hold a trade, to justify holding a trade. So this is the second secret now that really is a eye opener for a lot of traders. And I call it the 80-20 rule in trading. You've probably heard of the 80-20 rule, often called Pareto's principle, where a famed economist centuries ago noticed that 20% of people seem to hold 80% of the wealth. Not much has changed, right? If anything, it's gotten even more dramatic. But the idea in trading is that 80%, 80-20 rule, 20-80 rule, whatever you want to call it, is 80-20. 80% of your profits come from 20% or sometimes less of our trades. So you say, hold on, does that mean the other 80% are bad trades? No, it just means that there's some winners and some losers in the other 80%. But those doublers that I just showed you, that's why you don't want to take those target profits too quickly. You want to let your winners run. At the same time, if they're losers, you don't want to justify holding losers. You want to cut those losses reasonably quickly. The time stop is one of our ways to do it, as well as the price stop, so we start and trail with. The other thing is take every trade. Do not pick and choose. If you know you have an edge, your job as a trader becomes a lot simpler. It becomes just saying, I must follow every trade that comes out, whatever the system or method that you use is. If you start picking and choosing, you're not being systematic. You're basically letting chance and randomness and your own cognitive biases, your mental kind of hiccups or your mental, I should say, roadblocks are going to get in your way and not allow you to ride that bigger winner if you're used to taking 20 and 30% profits, or getting you too antsy and getting rid of a trade that otherwise shouldn't be held, or should be held, or otherwise shouldn't be held if you're holding on to something too long. Lots of potential pitfalls that we guide traders through with our weekly options accelerator alerts and follow-ups. So my whole strategy and philosophy when I launched Big Trends in 1999 was to say, I never will leave traders hanging. Even if it's not working, I'll say, this trade is as an exit, get rid of it, take the stop, take the loss, move on to the next trade. Because we teach reality trading at Big Trends. We don't teach fantasy trading and only talking about winners. So the idea, though, is that, okay, you'll see some other examples here of both winner. We'll talk about another winner, and then we'll talk about a loser here. So this is a Snapchat. Snap Inc. as the parent company is called. SNAP is a symbol. They recently got pounded on the downside. We didn't have that one, but that was an earnings related thing. But we had this one. We're not going to get every move, but we had this one as it just started to cross here. You can see we were getting in when the stock is sitting in here in the neighborhood of about 64 and a half. Okay, so it's 64 and a half. We're buying a 61 strike call out into the following Friday's expiration, the first Friday in July. Now, think about that. 64 and a half, we're buying 61. What does that mean the intrinsic value is? Right to buy at 61, it's 64 and a half, that's 3.5 points. You say, hold on, so we're paying a full point above that. We're paying 4.5 points. And we're saying, yes, for about a week and a half to go before the expiration, we feel pretty good about that. We don't expect to lose all that point over the next day or two because it's got, like I said, about 7 or 8 trading days till it hits its following Friday expiration. Notice as the stock goes from 64 and a half, gets to about 69, by the time we're getting exit, it's about 67 and a half. Well, at 67 and a half, of course, this thing has to be worth 6.5, and there's a little bit of time, obviously, on top of that. So we end up taking it out for a 54 and change percent profit the next trading day per our trailing stop, because obviously that's a little more dramatic of a move on a percentage basis from 69 to almost 67, right? So that's where that will eventually kind of catch up to that, giving up some of the profits. As it turned out, the ADX is rolling over there too, and you notice as ADX then comes down, what does ADX coming down mean? It means no trend. It doesn't mean it's going to go the other direction. You can see it just chops and goes nowhere over the next day. So the goal here is to not only let your money grow when you're in a good trending phase, it's also to just get your money back to cash when the price action is more uncertain and less predictable. There's never a guarantee on total predictability. Obviously, the markets always have a risk and always have any technical signal can go against you. Let's look at a losing example just in that vein here. This is Lowe's, the home improvement chain. We felt like on October 7th that this thing was a really nice, strong breakout to start off the day. Usually the bigger that breakout, the more we like it. And you say, a lot of people would say, oh, it's moved too far. But you'll typically see that some of the biggest ones will actually do the best on that first half hour by the 10 o'clock Wall Street time close. Notice we're in the neighborhood here of about 209 as it closes there on that first big green candle up with the ADX upturning. We're above the moving average filter. If we were below it, we wouldn't take the trade. Well, you can see at 209, we're buying a 202 and a half call. At 209, that means it's worth about 6.5 points, and we're paying just over 7.5, 759. So like a $1.09 out of that 759, about 15% of that option is time risk, about 85% intrinsic value. Now you see it edges up a little bit more towards almost gets 210, and then starts rolling over a little bit. We didn't hit our stop though, so it came back to about 208 by the end of that day, and then we got the negative gap against us where it opened down here around 206. So you say a 209 to 206, that's only a 3-point move. That's like 1.5%, and we lost 32%. So that's the leverage of options. That can happen. And that's why the way you manage that kind of volatility is by trading small, trading as small as you can. That's why I say, you want to make sure you've got the risk capital that one trade like that. Think about it, if you put $759 into a trade, you lose 32%, you lose like 225 bucks, let's call it. Can you handle that? Versus the potential to make 750 or 760. That's how you have to think. It's like, okay, I can make 3 times that when I'm hitting my target. So you have to look at it not just as like I get a lot of people that ask me, what's your winning percentage? And my philosophy is it's not just win percentage that matters. It's also size of win and size of loss. We want bigger winners and smaller losers. That makes our life a lot easier as traders. Here's another 100% gainer outlier trade that only took 24 hours. And when I say outliers, the idea is that I want to find these unusual moves. Outliers are a powerful thing that can work for you rather than just saying it's an exceptional circumstance here. You see that Weight Watchers gives us that signal. Second bar into the trading day, that's at 10:30. It's a red candle. You say, well, how are we getting a signal? Because remember, ADX is constantly adjusting it's losing old data, it's gaining new data. When you become a subscriber, you get all of our rule sheet settings and everything to follow along from home. So while past performance never guarantees future results, when we saw this happening, this is what I love to show people is that, hey, we're in this trade and not much is happening the first few hours of the trade. It's flagging around here, catching its breath a little bit after that first gap up to start off the day. But you see, it's kind of grinding higher, and this is not atypical. A lot of times that first day, we're up a little bit by the end of the day, but the big money's made on this trade the second morning into the trade, right? Our target is that we're out by noon on our target at a double, right? And this is a pretty low dollar stock. So you can buy a nicely in the money option, pay very little time premium, and you still get some really nice trend moves in each direction. Sure, this one kept going. And again, I don't care if it keeps going. I'm fine with that. The idea is let's take our piece of hopefully the sweet spot of the move, as I call it, in the middle of the trend. I believe is the easiest part of the trend to trade. When you're trading at the edges of the trend, if you're playing for reversals, that will be a lot trickier in my experience. So as you can see, these profits can add up quite quickly. With one winning trade, say you get one doubler, how many of those other losses could you take? If they're 20% losses, you could take 5 of those and still be, with a very low win rate, still be even with 20% losses and one doubler. Yeah, you could take 33% losses versus one doubler. The idea is that we can keep our losses relatively small, let our winners run. And so then it's just about knowing when we should place a trade. Let's just quickly talk about the ADX here. I'm kind of limited on my time here, so I want to just kind of quickly just walk you through this. Idea being that, look, when we talk about the platforms, loads of platforms have these indicators, the moving average filters, the DMI lines. The ADX is really our big guide here. The ATR, average true range concept, creates what we call our trade funnel. The goal, of course, of a funnel is to say, look, we want to narrow it down and just get the few here that are going to give us that sweet spot edge and cash flow. Quickly, just an explanation of the DMI and ADX lines. Wells Wilder, same guy that developed the RSI indicator, also he came up with this concept of true range, which essentially just shows you that when you're talking about ranges, you don't just look at the high-low, you also look at the gap. The gap is factored into these, so you know how much total movement you're getting in the trend. And then the directional movement lines show you, like I said, the net new highs, net new lows. So when we talk about ADX, the average directional movement, when you add up, we're getting more positive directional movement and less negative directional movement. That's higher highs and that's higher lows. You know what that's called? It's called an uptrend. Well, ADX will pick up that the gap between those DMI lines is rising, so then ADX will start to rise. And ADX rising is what you want to see in order to be a trend trader. If ADX is falling, you should not try to trade that. It's not trending. So the goal here is that we then come up with Wilder came up with a percentage calculation to compare different price stocks. And so we get these very active stocks with this strong momentum and trend-based indicator using the right weekly options, which for us is the in-the-money options, and the proper trade and capital allocation management saying, okay, we're going to help you trail the stops appropriately. We're going to give you the time stop when it's time to get out. We never leave you hanging, so you know exactly where to follow, or, hey, it's time to cash out of this at the double. This is what I call weekly options accelerator, and it's been a very popular strategy. Like I mentioned before, just on one contract, like on that AMD 118 strike call example, banked $118 of gross profit, more than $100 even after commission. We said it's like I said, on one contract, either way, it'd be less than round trip would be less than $2 typically that most people pay in a commission. That trade hit its target just 3 trading days. This strategy, how many trades are we going to generate? We expect to generate 9 trading signals per month. Some months may be more, some months may be less. But a couple a week is a pretty good average, or about 100 a year. And I'm very confident that once you try it, you'll not just like it, you'll love it. And how we follow up with you, you can get email alerts and text alerts to your smartphone. And the goal here, of course, is that, you know, one of these trades can more than pay for the special holiday offer that I've set up for you here. So the idea here is that, okay, we've just had our 22nd anniversary, but also it's the holidays. And it's a great time of year to kind of count our blessings as to how blessed we've been to serve so many thousands of traders. You know, we've obviously seen a ton of interest because of the influx of traders that are coming in, learning about options trading. And this is an ideal package to really get focused on a simple way to trade options, not trying to make it overly complex. I think you'll be a lot better off if you keep it simple rather than if you try to complicate things. You know, I think it was Einstein who said, make things as simple as possible and no simpler. You know, so the idea is that, okay, don't add unneeded complexity if you don't need it. And Long, you're very welcome on the presentation. I appreciate your kind words. You know, so what have I done here? Okay, typically, if you bought my service on a month-to-month basis off of my website, you pay a couple $100 a year, $197 times 24 months. I'm going to give you not a 1-year special. I'm going to actually give you a BOGO. Buy a year. I'm going to throw in a second year on me. That would be $4,700 alone, not to mention my weekly video updates every week. Over the course of a year would be $497. Over 2 years, what I'm offering you here, that would be actually more than that. It'd be like $994. So we'd be up over $5,000 in total package value. I'm going to give you a bonus access to my weekly options accelerator rule sheet. All that together is, you know, is already a very reasonable price for $5,000. I'm going to make it such a dramatic savings here, more than 90% savings, and take it down to $497 for a one-time investment to get you 2 years of access to all the trade alerts. Like I just told you, we expect to get you at least 100 trades a year over 2 years, 200 trades for less than $500. That's less than $2.50 per trade. Not to mention all the bonus access you get with my weekly video update and my rule sheet. And I've set it up at a special link here for you. I'm going to type it in the chat box here momentarily. It's going to be over here at members.bigtrends.com/WOA24 WOA for weekly options accelerator, and then the numbers 24 for 24 months access. $497 even for 12 months would be an incredible value, but at 24 months it's just off the charts. Because think about it, one of those trades, like I showed you in AMD, made subscribers $810. Make over $800 of profit off of one trade. You've paid for more than the 2-year access. I even have some subscribers who ask me, can I lock in more than the 2 years? Yes, I would honor this, as you could do this twice and get 4 years of access for $497 times 2, right? So what does it look like when you sign up for this and you go to this page here? I'll type it in the chat box as well. Members.bigtrends.com. It's not a www link. It's a members.bigtrends.com/whoa, WOA 24. You look at that and you say, okay, with that link, you say, send it to everybody here, that you can copy that over into your browser. That's going to pop up this really simple page here. Again, keep it simple. I'm not going to load it down with text. You've seen the power of this across multiple examples. You know that we're going to control the losing trades as well, so that you can win potentially a lot bigger than you lose on the typical target versus stop situation. And you say, look, you add those up over potentially a couple hundred trades, and webinar member, I'm in. Thanks, I appreciate it. Love to know your name as well. I guess I'll see it on the order form here momentarily, but I get a copy of all the orders, of course. But the idea here is that at this price, it's basically an insanely good value in my opinion, because it's not just trade alerts you're getting. What I haven't mentioned is that you also get a dedicated email to reach me and my analyst team anytime you have a question about your subscription, and, anything else that's on your mind. We can't give individual, individual recommendations on things we don't recommend. But if you've got questions on the trades that we've called out, you're not clear about what we're doing, or if we're in a position or not, you can always follow up with this, and we can update you on where things stand. Brian, thank you so much. We appreciate your business. Very, very kind of you, and we look forward to working with you over not just 2022, but most of 2023. It's a 24-month package, which is something that's worth reminding people about, because a year at this price would already be just to me an awesome opportunity to get started. But this is now doubling that value. So yes, Mindy, just getting on the presentation. Definitely watch the replay. We'll definitely be here for any questions you have. Notice it's got our 800 number on there. It's an easy one to remember. BigTrends.com. It's 1-800-BIG-TRENDS. Like I said, I launched the company in 1999, so we're on our 22nd year. So we've helped many, many thousands of traders, and continue to help many thousands to benefit from this. If you have questions too, it's got a dedicated email in there, clientcare@bigtrends.com. When you get signed up, all you have to do is just basically read the terms and conditions, click on the links. There's a link there or down below. Once you've read it, say I've read it, and then you can either do the credit card fill out, or you can go with the PayPal link. I do a lot myself with PayPal because it's just so easy to just a couple of clicks and boom, 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 it's all connected. And BD, thank you as well. I'm in. Let's do it. I appreciate it. I mean, at this price, I think you're going to see a lot of people that want to just lock it in. And I got to say also that the price is going up here very soon, because we've helped a lot of people, and the reality is, inflation's out there and costs keep going up kind of for just about everything out there. So it's a great time to lock it in and beat the price increase too. Are there video trading sessions, Bonnie asks, available and ready for us to, once you purchase, about how to purchase the options? Yes, we walk you through that, Bonnie. So and also, again, you can email any questions. You get dedicated email to our analysts, as well as with our client care team. So if you have questions, if something's not clear, we can walk you through it and talk you through it as you wish. So we're here for you. So we look forward to working with a bunch of you already. So thank you so much. I know you've got a good eye for value, and thank you so much for the opportunity, Anna, to be with you all. I'm going to hand it back over to Anna so she can get it ready for our next speaker, and wish you all a very happy holiday season.
Good morning, everybody, and welcome again from wherever you're listening in from. Thank you so much for being on the call today. Let's see here. So today I want to talk to you guys about seasonality stocks. Seasonality is nothing new, but I think part of what we did, which I'm very proud of, the work that we've done, is to be able to tell which seasonality stocks would work and which one would not. So we'll get into that in the 45 minutes that we have. So let's just go ahead and get started. First and foremost, as always, we are not licensed financial advisors. The government does want us to let you know that, so please be aware of that. And just know that everything we talk about here is just for educational purposes only. Okay. So before I start in there, I want to kind of just touch on something that's been happening recently in the market. So back on November 22nd, we have a report that we write about. And I told people, I said, hey, the market is getting ready to go down. And part of that was because of the things that we've seen on this platform. I don't know if you can see this image right here, very small. It says get in short or get out. So this is something that we program into our platform to just help us see technical analysis as well as quantitative analysis. It lets us know when we've hit the top and when we've hit the bottom. Long story short, you can see here, and I'll talk more about this later on, where we said, look, for this reason, combined with our knowledge of market cycles, which is kind of like seasonality, we are expecting a pullback soon, very soon. And our plan is to tighten up our stops and take profits, then wait for the next buy signal. Okay, this was on November 22nd. Now, prior to that, we had actually started seeing some stuff that said, hey, this is not looking good. Market is topped out. And one of the things was, if you see these three parallel lines, that's one of the things that we have here, is when price gets above that, we know things are not looking good. But on the 22nd in particular, there were things that showed us, wait a second, something bad is about to happen in the market. And now I like to tell people all the time, I say, even though the news is what moved the market, it's interesting how you can see certain warning signs before the news comes out. And the reason why I said that is because up until then, on November 22nd, nobody knew about the Omicron variant of COVID at that time. But we saw that there was something wrong with the market. And needless to say, we all know what happened. The market has been pulling back since then. Now, um, at the same time, on December 3rd, we saw again that the market had bottomed out. And so we wrote about that again as well and said, look, markets have bottomed out. And we are once again saying that since the market has bottomed out, investors should be ready for the markets to take us higher for the rest of the year. Now, a lot of people have been asking me, well, how did you see this? How did you know these things? And again, part of that was technical analysis, part of that was quantitative analysis. But the other part, which I want to talk about today, is seasonality. Okay, so we knew that market had to drop in November to give us a bottom in December. Does that make sense? And so because combined with all that information, we knew that, look, what was happening was not unrealistic. We just didn't know the magnitude of how it was going to be. But then again, by November 22nd, we knew this was very serious, expected drop very, very soon. It happened. So it's not coincidence. And I like to tell people the market is not random. There are things that we can learn to see that can tell us what is about to take place. And so we're very, very proud of our work. We've been calling market bottom since 2016, over and over. The pandemic, before it happened, we saw the top of that. When the pandemic hit bottom in March, we saw the bottom of that too as well. And so to be able to do this over and over, almost very consistently each month, we can kind of pinpoint the top for the month and the bottom for each and every month. And so because of that, I don't trade every single day anymore. We've got so good at being able to pick tops and bottoms. We get out when we see that the market is topped out, and then we wait for the next bottom that occurs the next month, and then we jump back in again. And so that's kind of what we saw in November. We knew the market had topped out, so we said, hey, everybody, and that's what we again wrote over here, expect the market to pull back. It's just that we knew that it was going to be more severe than normal because of certain patterns and data that started showing up. Then we said we will wait for the next buy signal, which was expected in December. So when December came, it was one of those things that, oh, here it is. Here is the bottom for December. So much so I was actually on a podcast this Monday actually, and the host was asking me, he said, hey, what do you think about the market? Do you think it's going to go up or down? And I said, without a hesitation, we've bottomed out. And the host was like, wow, you're so sure about this. How sure are you? I said, oh, I am 100% sure. And then I tracked back and I said, okay, you know what? Let me not say 100% because at the end of the day, I don't control the market. But here's what I would tell you from the data that we see, I am 99.99% sure that the market is going higher. Okay. And even he was like, wow, that's really bold statement. I mean, the market is volatile. I said, I know all the things that we all see out there. I'm aware of them, but it's the data that we see. And now combined with my understanding of seasonality, it's like it's a no-brainer that the market put in the bottom right now. We can see the information. And then I said, look, Santa Claus is already here. Because some people are going to be waiting for Santa Claus rally. I said, ladies and gentlemen, the Santa Claus rally is here. So I just wanted to touch on that because I'm very proud of that. And I think sometimes we don't talk about how successful we've been in picking tops and bottoms, that I just thought I should share that before I get started today. So if you're interested in learning how to pick tops, how to pick bottoms without guessing, we don't do anything in hindsight. Everything is before it happens. How to be very accurate, very sure. I tell people, I said, we don't guess, we don't hope, we don't wish. We see data. Okay. If you want to learn how to see data, I encourage you to listen to what we have to say and then join us for other services and products that we offer. Okay. But let's go ahead and talk about today's lesson. Now, today I want to talk about seasonality. Now, seasonality, for anybody who doesn't know what that is, it's very simple. It's been around before I was even born. So I'm not even going to say I created seasonality. The biggest thing with seasonality is that every year, certain stocks move for whatever the reason is. So think about Valentine's Day in February. Every February, we have Valentine's Day. Even with the pandemic, we still had Valentine's Day. The question becomes, what stocks could we invest in leading up until Valentine's that can help us capture the seasonal pattern of Valentine's? Okay, so if you were to think about it, and you can do it, what stocks do you believe you could benefit from when it comes to Valentine's? And especially the ladies in the room. If there's any ladies in the room, help me out. What stocks do you believe, or what companies, let me not say stocks, what companies do you believe might be something to pay attention to or maybe invest in because you know Valentine's Day is coming up? Okay. So exactly. So we have companies like chocolate companies. Okay. We have companies like the flower companies. Exactly. So when you have flower companies, you have chocolate companies, and these things are happening every year. The question is, have you been invested in these chocolate companies or these flower companies every month of February? Because guess what? It's going to happen again. 1-800-Flowers. Exactly. 1-800-Flowers is one of those stocks that we know has a seasonal pattern and takes advantage of Valentine's. So if you're aware of those things, then why would you not want to pay attention to 1-800-Flowers come February? And if you've been in the market longer than 1 year and you haven't paid attention to 1-800-Flower, I say you're missing out. Okay. And so one of the things that we try to help people do is, hey, what are some of the seasonal stocks that we can focus on in January and in February and in March, so that you can have a list of stocks that you pay attention to that you know are going to do certain things or move in a certain direction every single month for a whole year, right? So that's kind of like what we did. So when I first learned about seasonality, this was back in 2014. I learned about seasonality. And when I heard it, it just made absolute sense. And the stock that I was told about when they were talking about seasonality was this stock called Google. Now, at the time, it was at a meetup group that I was attending, and they were saying, look, Google's earnings in the month of October gaps up. Now, mind you, this was 2014. So they said for the last 10 years, 9 times in the last 10 years, Google's earnings gapped up on on the October earnings. And so here I am sitting there, and here's an example. So here's 2004, when Google first went public, was the year 2004. The earnings, you can see right here, this is that gap that it's talking about with that arrow. So the shares gapped up there. In 2005, this is earnings. Now, these guys were only playing the earnings. Okay, now we've taken it further than just earnings, but at the time, earnings was the only thing they were talking about. And so 2005 comes, we can see that Google gapped up again. Here's 2006. You can see that's the gap that happened in Google every October. Wow. And this is where some people might come and say, hey, what causes that? Why is this happening? And to me, it's like, I don't care what is causing it. More so than it's like, I want to know if it's going to happen again. Make the money first, find out the reasons why later. 2007. Now, all this time I wasn't involved in the stock market. I didn't know anything. But 2007, it was a small gap, but it still gapped up. Okay, that was 4 years in a row now. 2008, in the recession, earnings came out and it still gapped up. And then it fizzled out. 2009, after the market had bottomed from the recession, here comes Google, October of 2009 again. Boom, it gaps up again. 2010, huge gap up. Now, this is 7 years in a row now, ladies and gentlemen. Okay, so this is where, like I said, when these guys told me this, it's like, wow, why would you not want to pay attention to Google in the month of October? Here is 2011, same thing, gaps up again. Okay, so 2012 was the 1 year, the first time where it did not gap up. Okay, 2013 came, boom, it gaps up again. So at this point, you can imagine 2014, this is the first time now I'm hearing this, right? And they show me all this stuff. I can go back and look at it. So it's not just, oh, somebody trying to sell me a hot potato. I can see it with my own two eyes. And I was like, wow, this has actually happened. And at only one time it didn't happen. So the notion was, hey, if it's happened 9 times in the last 10 years, what do you believe is going to happen this time? Okay. If you don't mind, go ahead and I just want to see what you guys think too. What do you believe would happen in 2014 since we know that it gaps up on earnings in October? Some people say yes, it's going to gap up. Others are saying we don't know. That's fine. So here I am. My lucky day's here, and I'm full of excitement. We're ready to place this trade. I'm going all in, placing options. I'm dreaming about all the money I'm going to make and how I'm going to do all these great things with all this money. And I've solved the stock market riddle, right? And in 14, just my luck. As soon as Wally gets involved, Google decides to fail again. Oh man, you're talking about dreams being crushed. Hopes were being dashed and shattered. My feelings were hurt. I was like, what? I'm thinking, okay, yes, these market makers are watching my account. Now, mind you, my account is puny to the overall Google market. Forget the stock market, just the Google market. But here I am, crying to myself over spilled milk, thinking, oh, they must have been monitoring. They must have spy cameras on me, and they waited to see as soon as Wally got in. Now they're gonna sell this thing. Okay, so because of that, I was like, I'm not doing this again. So 2015 comes around, and I was like, nope, I'm still reeling off of the pain of what happened to me in 2014 because I went big. It was one of those where I tried to go all in on my bet on this because I was just so sure it was going to happen. And in 2015, I said, nope, I've been burnt, never doing it again. And then this is what happened in 2015. Gapped up again, right? And so I'm looking at this. I was like, you've got to be kidding me. They knew Wally was not going to be there, and he gapped up again, right? So if anybody can relate to what I'm saying, I mean, these are the raw emotions that I'm feeling. 2016, I decided to jump back in, and guess what it did? It gapped down again. I said, you got to be kidding me. 2017, I said, I'm not doing it. It gaps up. 2018, it does this. 2019, it goes up. 2020, it gaps up. 2021, it does well. Okay. So I'm sitting here and, this is even before 2021, but this idea of, wow, why is it that it did not work? Or what would I have been able to see to tell me that, you know what, this year, seasonality might not work? Now, I have good news and I have bad news. The bad news is on earnings, I have not figured out the answer yet. One of the good news is anything outside of earnings on a regular stock that just has seasonality throughout a month, I figured out how to tell which ones are going to work and which ones are not going to work. That makes sense? One of the ways I was able to help see this was because this gentleman right here named Jim Simons. Jim Simons is a mathematician. He hired a bunch of statisticians, physicists, and they came up with a model on how to use math to understand certain patterns in the market. And because of his knowledge of math and what they were able to discover, he realized the stock market was not random, that there are certain patterns that occurs in the market over and over and over again, that if people were to pay attention to those patterns, they will make money consistently. And so he took this and created a model and, got a lot of hedge funds money and turned into billions of dollars. Till today, he won't even reveal what his secret is. Anybody that worked for Jim Simons had to sign a huge non-disclosure agreement not to discuss anything about this model. But you know what? The good news was I heard him speak. And even though he didn't go into details, this concept of just the stock market is not random was enough for me. Because Jim says, look, like his organization, they look for patterns that they know will not occur at random. If they believe the pattern is occurring at random, they will not trade that pattern. And so the only thing they wanted to focus on were things that had a random pattern. So from there, I started working on what are some patterns that I could physically see with my own two eyes. I started working on that. I understood seasonality, and I like the concept of seasonality. Every year, things were to happen. But my question is there a pattern that shows up for the seasonal stocks that would move from the ones that were not? Okay. And that's kind of like what we did here. So we created our whole software. We have a software called the Right Side Platform that increases our success ratio with seasonality trading. Okay. And the biggest things that we did when we put this together, which we wanted to make sure that we don't miss out on the good ones. We don't exit too early from the ones that are doing well. And we want to make sure that we're not dumbfounded trying to figure out, is it going to work this time? That was my biggest question was, is it going to work this time? Because what happened to me with Google in 2014, I did not want that happening again. Okay. So like I said, I don't use it on earnings anymore, but on regular stock patterns outside of earnings, we have mastered this. Okay. We have mastered it. And so it will let us see clear signs of when a seasonal pattern is actually beginning to move. So here's an example of one that we did in October, a company called Forward Air. Okay. We knew that Forward Air every month of October rallies. In this year, 2016, it rallied 20%. 2017 only went up 6%, but the key word is it still rallied. 2018, 12%. 2019, 18%. 2020, 26%. So here we were in 2021, this last 2 months ago, okay? 2021, we knew this was one of the stocks that we have for our October list, and we knew that this stock rallies in October. The question was, how could we tell whether or not it was actually going to move? And so I actually wrote a whole report about this in our Right Side report, which I highly recommend. If you don't have the Right Side report, you want to get a copy of the Right Side report. But needless to say, in there it says this stock finally gave us our buy signal for the first time since February. And the timing could not be more perfect. Ford has a history of rallying in the fourth quarter, starting in October and maybe early November. So you see, with this right model, giving us a buy signal, and that's where this comes into. So everything that we've learned about quantitative analysis that lets us know when a seasonal move is about to begin, it comes in this right model, right in the month that we know is supposed to do something, and it would tell us whether we should be buying or not. Okay. There are three things I want to see on this platform. I want to see that it gives us a buy signal in the month that we know is supposed to rally. I want to see that it was already red background, preferably. It doesn't always have to be, but if we have a red background, that's great because that means that it's been dropping and it's ready to go higher. But the most important thing is we want to see this buy signal or buy cover signal. We want to see this background turn green or be green, and we want to see a green candle. So we see those three things, a green candle, a green background with a buy signal in the month, preferably a week or so before the seasonal pattern is supposed to move. We know the stock is ready to rally. Okay. So we saw that and we wrote about it in there. Here is what our seasonality shows us. See this right here? This is a seasonality chart. And what we did here is we have something where it tells us in the next 6 months. So from here, where this line is, this gray line here, going forward, it lets us know the most consistent rallies and the most consistent drop, not the most profitable, the most consistent rally and the most consistent drop that a stock has in the next 6 months. Now, why is this important? Because we know that if this is the most consistent, I like consistency over profitability. I'll tell you that right now. Because if I know that it's consistent, I can plan better around that. So what we look for is like, where is this green bar showing up and where is this red bar showing up? And so back in October, when we saw this, we knew that, wait a second, the seasonality is coming up. And you can see right here, this is what we're looking at. For the next 20 days, this stock should rally. Over here, on the other hand, we had where it's dropping, but we were not interested in a drop more so than we were interested in the rally. What ended up happening was that when this then gave us that buy signal in October, we knew it was time to buy. So you can see this right here. This is the reason why we said here, it is time to buy. And notice what we said. We do not believe this is random. Why? Because this quantitative data that the software picked up showed that the same quantitative data that occurred in October last year, the year before that, and the year before that was showing up again. Okay. And so once we saw that, we knew it was time to buy. What ended up happening was this is where we got our buy signal, right? And the stock moved all the way up to there in the month of October. Bingo, another year in the bag. Now let's move on to the next month. And this is what we do every single month. If you had bought 100 shares, just 100 shares of the stock, your profit would have been $1,600 in 17 days. That's an 18% return on your money in 17 days. Ladies and gentlemen, and this is just one stock. What we try to help people do is like start building how many more of these stocks occur in October. We know about Google. We know about Forward Air. There's plenty more that you can choose from that can do this kind of stuff. Okay. If you bought one option contract at the money when you got that buy signal, you would have paid $520. 17 days later, you would have walked away with $1,255 in profit. Not shabby for not trading something that is random. We don't trade random. We trade things that are consistent over and over and over. That makes sense? So here we are in November. Well, we just had November. And so in November, we noticed that, hey, one of the things that was happening, because we knew that the market was ready to go down. Okay. So that's the other thing too. Like you have to make sure that you're following the seasonal patterns based on what market condition is doing as well. So when the market is bullish, we look for bullish patterns. When the market is bearish, we look for bearish seasonal patterns. Okay. So when we knew that the market was at the top and at any point in time we could start rolling over, we said, look, let's not focus on bullish seasonal trends. Let's focus on bearish seasonal trends. Does that make sense? And so in there, we wrote about this in our right side report again, saying that, look, the shares of Salesforce has a seasonal pattern, an upcoming seasonal pattern that is going to turn bearish. Okay, that is going to turn bearish. And so that's what we did. And then let me show you this, because this is the platform here. What you'll see here is this is what I'm talking about, where we had a green background. So November came around and it was green, but because we expected it to go down, we wanted to go from green to what? To red. Does that make sense? Now, on the first red candle, we didn't get the signal just yet. So on this candle right here, November 18, all it was telling people to do was get in short or get out of the market. And then over here, it was warning all these bulls, get insured or get out. Now, when we started seeing that, we knew that the tide was beginning to change. Why? Because now that is warning all these bullish people, like, get out, get insured or get out, get insured or get out. This is something that tells us get ready for what? It to roll over. Now, the one thing we knew was that in November, Salesforce has a tendency to drop. Okay, Salesforce has a tendency to drop. And so the only thing we needed was a sell signal. We needed to wait for all the quantitative data to tell us it's time to sell. And that's what it did on this day. Once it did that, boom, we knew it was time to start shorting. We knew the seasonal drop of Salesforce was going to begin. This is not random anymore. This is not guessing. This is not hoping or wishing. And it dropped. And the beauty of this is not only does it tell us when it's time to start shorting or the trend is about to begin, but it helps keep us in that trend for as long as possible until the trend begins to change. And the reason why that's important is because the next day it tells us to wait and hold. You shouldn't be shorting. You shouldn't be doing anything. Just hold on to your position. Hold on to your position. Now, notice what happened on this day where it gapped up big and it moved up big on this green candle. And this is where most people would have been panicking. Oh my gosh, what's going on? And all it said was this: get insured or get out. So you could have either, sold, but what we try to tell people to do is insure yourself. So if you insured yourself, what would have happened is the next day you'd have still been okay. It just says place a stop on your short positions and it allowed you to do this. At this point, it's saying wait and hold, wait and hold, wait and up until yesterday. All it's telling us now is place a stop on your short positions. Okay. If you followed those things, well, at this stage, what would have happened is 100 shares of this stock that you shorted would have yielded you $3,232. Okay. Now, 10%, maybe not too exciting for 16 days. But you see, the key here is we knew Salesforce was supposed to go down in the month of November. Okay, that's the beauty of this. We knew that Salesforce was supposed to go down in the month of November, and that's what it did. When you have those signals, when this platform now tells us, yes, go in and start trading this because we know seasonality is about to start, what you'll see is if you just buy at the money options, this is what we did, just one contract at the money would have cost you 1,100. You stay in. Okay, we know that's the other thing too. It lets us know how long we should stay into a trade. And then we have an idea, but you can stay in, and as long as the model, this right model, doesn't tell you to get out or exit or something like that, if it tells you to place a stop, you place a stop. If you get stopped out, then you know you're out of the trade. But as long as you're still in the trade, you don't get stopped out. This is what would happen 16 days into this now, 144% on the option. Okay, I want to show you this one. This is Bank of America. We were expecting Bank of America to rally in November. Bank of America has a seasonal pattern of rallying in November. So we actually wrote about this also in our report. We said, look, guys, the month of November, Bank of America is supposed to rally. Pay attention. The thing was, in November, so this is where November began, we were waiting right here. So we knew starting here in November, Bank of America stocks, we need to start paying attention to them. But on that day, November 1st, notice what the right model told us on the right-hand side here. Make sure this, I want to circle this right here so you guys can see this. Pay attention to what the right model says each day starting November 1st. So on November 1st, it says wait and hold. So we said, look, let's wait. We're not buying anything yet. We need a buy signal before we can start buying this. Now, we knew Bank of America rallies in November, but we were waiting for the buy signal. The next day, no signal. The day after that, still telling us to wait and hold. This day, it then tells us get in short or get out. At that point, I was like, something is not right. Because if anything, it should be telling us get ready to buy, not get yourself insured or get out. And this, ladies and gentlemen, is one of the best features of this platform, is it allows us to not get stuck. in stocks that are not going to go where it needs to go. And part of that's because, again, there's data that lets you know when a stock is ready to go bullish or not. So at this point, getting sure to get out is telling us get out, get out, get out. And notice how all this time now we waiting and waiting and waiting, and it never gave us our buy signal. Before we knew it, we said, you know what? This is not going to happen in November. This is not going to happen in November. And so we said, no, at that point in time, the overall market started looking bad. And we said, okay, something is not right with this market. And maybe that's why whoever these investors were that were supposed to be buying when Bank of America decided not this time, not this time. And as you can see right now, till now, we still don't have any buy signal. So we're already in December, and we looked at it, it's like we saved ourselves from jumping into Bank of America based on the seasonal pattern, simply because we knew that we were supposed to get a buy signal, and it did not give us that buy signal. Does that make sense? And so that's kind of like what the power of this platform is. If you understand seasonality, and now you just say, hey, I understand seasonality. I know that this stock moves every month of December. What should we be paying attention to? How do we know if this is going to move? That's where this platform becomes helpful. But not just that alone, okay? Because even with the S&P 500, when the market started, running into trouble, this is where I was saying right here. See on the 22nd? This is when we started telling people, hey, wait a second, something is not right with this market. Because on that 22nd, look at what it said. It says, get insured or get out. Get insured or get out. It was practically begging people, get yourself insured or get out. And that's why we wrote about this in our report saying, wow, markets is getting ready to tumble. You either need to be insured or you need to get out. Okay. So this is basically what I wanted to show. There's a whole lot more, but I know I've run out of time. Just want to show you guys this. At the end of the day, if you have questions, by all means, please ask questions. I'm not sure I don't know how to read the questions box right here, but if you do, just let us know. But at the end of the day, one of the things is I want to invite you to come, try out this platform for 30 days, 90 days. Try it out. It's just another tool that you can add to your arsenal to help you see what's going on in the market. Okay. You can go to this link down here. Hopefully you guys can see this, rightside.trading.com/expo. We gave you guys a special discount of 50% off for anybody who uses this link to come use the platform. Okay. And so this is where you can see this right here. This offer ends on Sunday, and it's Expo. Don't use promotion, Expo. rightside.trading.com/expo. Okay. The offer lasts until Sunday midnight, so take advantage of this, ladies and gentlemen. This is the report. You get part of what you get when you sign up for this. You also get this report. I'm going to throw that in there for free because I think, it's one of those things where people love to see this report because of the insight we have about the market. We are able to see what goes on before, in most cases, the news comes out about it. Okay, we're able to see and identify some of these signals, these warning signs before that happens. Okay, let me show you guys this. Let's see here. This was the pre-pandemic. Again, before the pandemic hit, before everybody knew what the pandemic is as of today. Back last year in January, this is where it said, look, we need to be ready for either slowdown at best or a reversal at worst. The writing is already on the wall. See, when we say things, like I said, even in the podcast that I did on Monday, when the guy said, how sure are you? I'm like, I am 99.99% sure. I'm not 50-50. It's one of those things that when we see things, we know. And it's not because we have a crystal ball, it's just the data is there. And we've seen this data over and over and over. And every time we've seen this data tell us it's going to do something, you will literally see the market follow through. Within 1 day to about 2 weeks later, you'll see it follow through. And so when we start seeing these things, we know we don't even question this anymore. Okay. And so that's why in this, it wasn't like, oh well, let's hedge ourselves or anything like. No, it's like the writing is already on the wall. It's time to take your profit, exit your positions because the market is warning us to take heed. There was a lot of people that were not aware of what we saw. It was like something bad is about to. Now, again, we had no idea it was going to be the pandemic, but we knew something was wrong simply because of the data, right? And then, as we all know it, market then drops. As the market was dropping, the whole world is shut down. Unemployment rate is record highs. People were filing claims left and right. Everything was horrible going on out there. And then in March, we saw a bottom. I was like, what? So even for us, I won't lie, we were shocked. It's like, wait a second, nah. Because we were expecting, I mean, as severe as February was in the beginning of March, we just knew this was going to be worse than the financial crisis. We thought this was going to be worse than the dot-com, right? Because after all, even in the financial crisis, the whole world was not shut down. Even during the dot-com crisis, the whole world was not shut. Even during the Great Depression, the whole world was not shut down. So we've seen the whole world shut down. People in England, Germany, Australia, Canada, everywhere was shut down. Unemployment rate was the highest we've ever seen. So, and every single day you're hearing about people not being able to go to work. Restaurants closed. So I'm just thinking, yes, this is going to be the worst thing ever. We're not going to see daylight for at least 2, 3 years. And then in March, we see the data telling us we've hit bottom. And I was like, what? Nah, something must be wrong, right? So I kid you not, this was the one time even I doubted the data. I won't lie to you. I doubted the data. I said, I don't know about this because it doesn't make sense, right? But we saw the data. And so by the end of the week, I said, wow, this data is there. So I said, you know what? The answer to this is because the question is, have we found a bottom of, or is this just a relief rally? And I said, the answer is the market is communicating that it's time to cover all our short positions, exit all our short positions, and get ready for a rally. And so we did. And I literally watched from the end of March to about June, July, while people were still on the sidelines, betting against the market. They could not believe, they were in denial that the market was ready to bounce back up. And I was like, oh my gosh. At that point, I realized we had something that most people do not have, the ability to pick tops and bottoms. And if that's something that you want to understand, that's something you want to know, that's something where my thing was when the financial crisis happened in 2008, I swore to myself, I never want to get caught in another bear market. And when I got involved in the stock market in 2013, 2014, that was my number one goal, was to study market tops. Okay. Because I did not want to get caught in that. And the problem then was you hear people talk about bubble, bubble all the time. Bubble, bubble. Is this a top? Is this a top? And I was like, I don't know. And I said, you know what? I don't want to have to rely on anybody else. I want to look at data, the data that is non-emotional. What are the data? What are the signs that said this is a top? And you know once you see it, it's going to fall. And if it's not there, you're fine. And that's what we study. And when the when the COVID situation came, man, we aced it to the T. Now, once we started understanding the tops, the one thing I then realized is like, wait a second, nobody talks about the bottom. Because in 2009, when the financial crisis bottomed in 2009, I was thinking that we're still in recession. Up until 2013, I still thought the market was in a recession, only to find out, oh, no, no, no. The market bottomed out in 2009. So that's what launched me into studying bottoms as well. So I went back all the way back to the Great Depression. How can you study and tell the market is put in a bottom, not a fake bottom that's going to break through, or a relief rally. I want to know the real bottom. And so we started doing that. And so when we saw this in March, it's like, wait a second, this is too early. But you know what? It's here. Let's go for it. And I watched, like I said, for 2, 3, 4 months while people were denying that the rally was occurring. The Nasdaq made all-time highs. They said, "Oh, that's just the Nasdaq." Then the S&P made all-time highs. Then the Dow made all-time highs. At that point, the denial turned into frustration, and people was like, "Oh, greedy Wall Street people." And it was at that point I realized, wow, people do not understand how to read data like we do. So I encourage you. And all that stuff is what we now put into the platform. Okay, you can use that to help you see when markets have topped out and when markets have bottomed out. And then you combine that with seasonality. I have a scan where we can scan for stocks. What are the stocks that have a seasonal move that begins this week? If you want to know the seasonal stocks that begins this week, we can literally go out there and find them. Let me show you this. Um, Come right here. You go here to the screeners. Okay. I can click on this seasonality scan right here. Okay. And I can pick a list of stocks that we imported in here. And all I have to do is hit run. If I hit run right now, it's going to take a while to do it. So I'm not going to hit that run because it takes a few minutes to run. But once it finishes running, it will come out with all this list of stocks and tells you exactly which ones have a seasonal move as early as tomorrow. Would you like to know what those is? That's what this platform can do for you. So you get all these features when you sign up and use this platform, okay? Because right now there are stocks that are ready to rally. There are stocks ready to rally. So needless to say, again, when the market topped out for the Omicron, get insured. You do not want to be long. This is what we wrote in our report. You do not want to be long, at least for the short term. You do not want to be long. Look at what I said. Let me make that very, very clear. This was on November 22nd. I was telling people, you do not want to be long. Okay, not, oh, let's see what's going to happen. Hedge yourself in case it goes up or hedge yourself in case it goes down. No, it was very, binary or very universal. It's like one way. Let me put it that way. We were very confident you do not want to be long because we saw the data. And when the market dropped and everybody's like, what's happening? Oh, it's the Omicron. I said, oh, okay, so that's the name. So was it that they knew that the market was going to drop before they made the announcement of Omicron? Maybe, maybe not. But the beauty of what we relish in is the fact that we saw the warning signs before the announcement was made. Okay. Then we had this. I said, it's a hilltop pattern. I said, this is making me say, whoa, this is not good. Let me repeat, this is not good. I said, for this reason, combined with our knowledge of market cycles, we expecting to pull back soon. How soon? Very soon. Our plan is to tighten up stops or take profits, then wait for the next buy signal. And that's what we got here on December 3rd. Markets have bottomed. We wrote about that. We are once again saying that the market has bottomed. On Monday, on the podcast live interview, I was talking to the host and I said, the market's at bottom. How sure can you be? The market is volatile. It's uncertain times. I said, no, the market has bottomed. We don't guess, we don't hope, we don't wish. The data was there. Investors should be ready to do this. So here's some of the things that some of the people have told about us. You guys are the best chartists ever. Everything that's happened, we saw it coming a week before. Okay, so these are things that you can see. I just want to let you know that this current bull market, I've seen the SPXL probably for the same reason you saw it. At this point, it is my best trade. I want to thank you for your patience and guidance, acting as a father should. Okay, this guy wrote, I felt compelled to write you, let you know just how much I got out of your webinar the night before. Today, I am like a kid in the candy store. You know why? Because he had that seasonality scan. It's like I'm like a kid at the candy store, and I'm also checking all my positions with with your new improved software. I'm just waiting to let this thing work. So again, my time is run out. So excuse me. I'm gonna say go to rightside.trading.com/expo. Get this discounted price. If you go to the website, the regular website, you'll be paying $2.99 for this. So that's why I said you get it half off. If you go there, if you want for 1 month, you get a better deal. If you go for 3 months, and you get the best deal if you just sign up for 6 months. You will be able to come to our weekly webinars. We call it the analyzing room. We don't call it a trading room because we don't trade in there. It's every evening, every Monday evening at 8 p.m. Eastern time. This is where we then analyze the market. I encourage people, bring stocks. Let's analyze these stocks. We use the platform to analyze it. I show you some stuff that I know from just also quantitative and technical analysis. I show you stuff from candlestick patterns, other stuff, and we just sit down and we analyze. Here's what's going on. We talk about the broad market. We talk about in sectors. We talk about all kinds of stuff, so that we have an idea of this is what's happening, and then how to use the software to say, let's buy this stock, let's stay in this stock. Should we be selling this stock? Should we hold on to this stock? And so on and so forth. So again, it's not promotions. Sorry about that. It's Expo. Just remember that it's rightside trading / Expo. Okay. So I hope that helps. Again, if you have any questions, email us at info@rightsidetrading. Other than that, have a wonderful, happy holidays, and we'll see each other hopefully soon. God bless you all.